Welcome and thank you for participating in this webinar on the long-term impacts on oil demand after a crisis. Please note this webinar is being recorded and all participants are muted with their video turned off. My name is Elise Vors. I am a Senior Program Coordinator at the United States Energy Association on the Energy Utility Partnership Program, based in Washington, D.C. To give a brief background on USEA, we are a nonprofit membership association of public and private energy-related organizations, corporations, and government agencies. USEA represents the broad interests of the U.S. energy sector by increasing the understanding of energy issues, both domestically and internationally, through the capacity building activities and events like this one. If you'd like to learn more about USEA and our work, I welcome you to go to our website at www.usea.org. We would like to thank our members and partners for their support in the energy sector during this difficult time. Each of us have felt the effects of this global pandemic, and we continue to work together to recover and come out stronger in the end. Today, we will be looking at the long-term effects this crisis has had on global oil demand and what this means for the economy, geopolitics, and society as a whole. I'm happy to introduce our speaker today, Dr. Marie Fagan, who is the Chief Economist at London Economics International in Boston, Massachusetts. Marie has conducted research and consulted in energy economics for over 30 years. Her work has spanned international upstream, midstream, and downstream oil, gas, and coal. Prior to joining LEI, Marie was with the Cambridge Energy Research Associates, as well as the United States Energy Information Administration. She holds a PhD in economics from American University in Washington, D.C. And as a former AU alum as well, I gotta say, go Eagles. We will begin this webinar with a presentation by Marie and then move to a Q&A session. If you have a question, please use the Q&A button below. We thank you for your participation and support of our activities, and we look forward to you joining us for future events. I hand it off to you now, Marie.
Okay, thanks very much, Elise, and thanks to the USEA for hosting London Economics. I'm going to switch for a minute to share my screen to show the slides. Bear with me. Okay, can folks see my slides? Hold on a second. Just in the right order. Okay, Elise, can you see my slides?
Not yet. Can you click the share screen and then select your presentation?
Okay, let me go back. Share screen. Oh, I see it.
There we go.
Okay. Slideshow. Beginning. Okay, that looks better, right?
Yes, perfect.
Okay, great. All right, so thanks. Sorry about that. Right, so we all know that the coronavirus economic crisis has crushed oil demand globally, and the decline for 2020 is predicted by the International Energy Agency to be about 7 times larger than the decline in oil demand from the global financial crisis a number of years ago. But we all know that the economy will eventually recover, but what about oil demand? So that's what we're going to be looking at today. So we'll start with a quick introduction, and then we're going to have a look backward, just a couple of slides to ground us in history and give us some perspective. We've seen crises in the past, and how did those play out for oil demand? And then we're going to focus on measuring the impact of economic activity. How does economic growth, also known as income, how does that impact oil demand and how that's changed over the past decades? And then in section 4, we'll take a look forward at what all this history and measurement of economic impact means going forward, including some comments on policy implications of what this research reflects. And then we have an appendix with some technical details for folks who are interested, but we won't be going over that today. So when the economy recovers, what should we expect from oil demand? So we've obviously had a collapse owing to the measures that we've taken to contain the COVID-19 pandemic, but the question is, to what degree will demand come back? And even though we have a temporary lockdown, it could have permanent repercussions. Amy Myers-Jaffe from the Council on Foreign Relations noted that every year in the US, we waste about 6 billion gallons of gasoline in traffic, and that ends up being about 4% of gasoline consumption, so it's not trivial. On the other hand, even if we all start going back to work, even if travel to work recovers fully, you can see here in this pie chart looking at vehicle miles traveled, it's only 21% of vehicle miles. So all these other trips, they're more discretionary, home, shopping, errands, that's half of travel. You look at social and recreational. So we can look forward to going back to work and seeing our colleagues and getting back into traffic. But we really don't know how this is going to play out in the longer run when there's a lot of discretionary travel that's out there too. And that's not to mention airplane trips and use of fuel for those purposes. So we don't have a lot of, we just don't know what the structural changes might be going forward. But we do have some history to look at for how economies and oil demand recovers after crises. So to look at this, we wanted to measure the drivers of global oil demand and just briefly tell you the purpose of our research and our approach. We conducted an in-depth analysis of oil supply and demand shocks since the energy crisis of the 1970s. We looked at 40 years of data to learn how demand responds. And to give you some background on the purpose of the research, we were engaged by Columbia University's Center on Global Energy Policy. They were interested in having a study of what we call income and price elasticities of demand for crude oil and refined products. We looked at gasoline and diesel fuel as well. Income and price elasticities are just the impacts on oil demand from a change in income, and income being GDP on a country level, and price, obviously the oil price. These play a key role in forecasting crude oil demand and looking at where demand might end up as we go forward. So the research that we did for CJET provides the foundation for the presentation today. And our approach was it was data-driven. We examined data for oil demand, oil prices, and GDP, which is income, over 4 decades. We looked at 25 OECD countries in a group. We looked at 18 non-OECD countries, handled them in a group. And we looked at 5 oil-producing countries. We're going to focus today on the OECD and non-OECD countries and the results. So we looked at the historical trends, and we developed econometric models to identify the impact of economic activity and oil prices separately on oil demand. And I'll share with you the key takeaways that we'll be working through as we have the discussion this morning. So even though there's been decades-long growth in global oil demand, the rate of growth has slowed over time. In other words, the oil intensity of economic activity has declined. And by oil intensity, it's just barrels of oil per dollar of GDP or $1 million of GDP. But it wasn't a steady erosion of oil demand per dollar of GDP. It wasn't a steady erosion of the oil intensity of economic activity. Instead, it happened in several step changes. Sometimes it happened in response to an energy crisis. In other cases, it was the result of structural changes going on in economic activity. And after each step change, oil intensity didn't recover, even after many years. And as we think about what this means going forward, we are now in a situation where we have both things. We have a near-term crisis and we have structural changes on the cusp. We have both these things in place now. And that does indicate that longer term growth in oil demand is going to be at a slower pace than in the past. And then when you step back and think about it, it does mean that we have perhaps, we hope, a short-term crisis, a short-term shock to demand, but we project that it will have long-lasting impacts. So let's have a look backward, a couple of slides just to ground us so we understand where this has gone in the past few decades. So as I mentioned, we have a less oil-intense global economy, but this didn't happen in a steady decline. It was what we're calling a descending staircase. So here we're looking at global oil consumption per unit of global GDP, and it's in barrels per day per $1 million of GDP normalized to 2016 dollars. So we think about this time period and what's gone on in the oil market in the world. If we start with this energy crisis period in 1976, we had about 2.6 barrels a day of oil were required or associated with $1 million of global GDP. So, and then of course we entered the mid 70s into the late 70s. We had the first Arab oil embargo, 73, 74, that drove oil prices up and contributed to a global recession. And then the Iran-Iraq war in 79, 80 pushed oil prices up further and challenged the global economy even more. So we see, of course, a decline in energy intensity during that period. People drove less. They had to wait in line for to buy gasoline, if folks remember that. And there was also various energy efficiency programs that were just beginning to take place, but mostly you saw a response related to slower economic growth and higher oil prices. And then oil intensity seemed to recover for the next few years from about 1980 to 1984. And it didn't quite reach previous levels, but it did seem to recover, and the oil industry might have breathed a sigh of relief looking at those numbers. But it's really just an artifact of the data, because what happened there was the economy took such a hard hit that relative to economic growth, the economy did worse. So it looked like energy intensity, oil intensity was increasing, but it was really just a statistical result. And that recovery was quite short-lived. It only lasted till about 1984 when the global economy got back on its feet. So then starting in 84, 85, we started to see the next sort of stair step down in oil intensity. Energy efficiency programs such as CAFE standards for automobiles were starting to take hold in the United States, and there were other energy efficiency programs going on in other OECD countries. In our next slide, we'll take a closer look at OECD versus non-OECD trends. We had a long period of low oil prices during that time, but even over this very long stretch of low prices, which you would think maybe would help oil intensity improve if oil's cheaper relative to other things that people can buy. But even over this long period, we did not see a huge increase in oil intensity, and it did not recover to the previous levels of the mid-1980s. And then starting in about 2002, we saw a third stair step down. This was driven by non-OECD countries, and we'll look in more detail at the next slide what went on there. And then we had, of course, the global financial crisis in 2008, 2010. But by about 2012, we had oil intensity of GDP down to about 1.2 barrels per $1 million to 1.3 barrels per $1 million. And that's pretty much where we were more or less before the COVID-19 pandemic hit. So then to step back and summarize a little bit from this slide, what history teaches us is that we've got declines in oil intensity, whether they're driven by high prices or driven by changes in the structure of economies that we'll look at later. They don't recover, the oil intensity of the global economy doesn't recover to previous levels. So you said we have a look at OECD versus non-OECD. So if you look at this chart, it's also oil intensity, consumption per unit of GDP. The gray line there is non-OECD, the orange line is OECD, and the blue line is the world average. In the first period, let's say 76 through, we split our data 76 through about 96, OECD countries were instrumental in the decline in global oil intensity. As I mentioned, the US had energy efficiency standards. Other OECD countries did as well. Some countries also instituted fuel taxes, et cetera, to bring consumption down. In the second half of but you didn't see a huge decline in the beginning anyhow from the OECD countries. But in the second half of the period, the decline in global oil intensity was driven much more by the decline in oil intensity in the non-OECD economies. These economies, like the OECD economies before them, started moving away from energy-intensive manufacturing. This is obviously happening in China, going towards more service sector economy. China was one of the big drivers of this trend, but you also saw it in other Asian economies and African countries as well. So we saw, so in this graph then, it encapsulates, especially when looking at the non-OECD countries, the drive in oil intensity that happens when economies start to do things differently. So the look back is informative, but we need to delve more deeply to be able to measure the impact of economic activity on oil demand. And that is to determine what economists call the income elasticity of oil demand. When GDP rises or falls 1%, what does that do to demand for oil? So to measure the impacts of economic activity on oil demand, again, referred to as the income elasticity, we know that at the same time that GDP is growing, or even if it's not, like in a recession, there are other factors that could impact oil demand, especially the oil price. And we also know that oil prices are volatile. They're closely watched by consumers and producers. There's no consensus on exactly how much impact oil prices or economic activity have on oil demand. There have been decades of econometric studies to provide a variety of estimates of these impacts, these elasticities. And the estimates vary depending on the time period that you look at and the countries that you study. Our research that we're presenting today covers 40 years and 48 countries. We wanted to be as comprehensive as possible when we started to parse out the impacts of income versus oil prices. And just to show you the reason that we really do want to make sure we control for the effect of oil prices is that they cycle through ups and downs, and we do need to account for their impact on demand. So here we have a graph of Brent crude prices, and you can see prices rising and falling depending on what's going on in the global economy. There were supply shocks, obviously the energy crisis, raising prices. Then you saw a gradual increase in non-OPEC supply. We had high prices during that period, incentivizing production from places like the North Sea, Mexico, the North Slope of Alaska. These all started to come into play, incentivized by high oil prices, which helped reduce prices. Then Saudi Arabia opening the taps. They had been fighting hard to maintain market share and support prices. And then, as we saw recently, for example, in 2017, decided that this, they wanted to get market share back and open the taps, prices fell. We sort of bumped along in low oil prices, and then we had the Asia financial crisis, which reduced prices dramatically, but only for a brief period of time. The global economy grew after that and supported a very large increase in oil prices over a very long period of time until we had the global financial crisis, which briefly depressed demand and briefly set prices back, but they recovered quickly. But in the meantime, there was, with these high prices, again, incentives for other producers to develop technologies, to bring oil to the market. And in this case, a lot of the non-OPEC supply growth was in the US tight oil shales, the development of the Permian Basin and the Bakken Shale. And these, again, with all the supply coming on, reduced prices. Then we saw somewhat of a bump up with Saudi Arabia, again, sort of pulling back production in 2017-18. But the point of this is that these prices change, consumers and producers pay attention to them, and you have to control for it if you really want to isolate the impacts of what's going on in economic growth on oil demand. So a way to do this, widely used, is econometric analysis, and that helps us isolate the two different impacts. So we have details of the econometric model that we used in the appendix to this. So I don't want to go into that in a lot of detail. I just want to share with you some of the high-level results. So the high-level takeaway, and I'll go through all the pieces of this here, is that the impact of economic activity on oil demand is lower now than it was in the past. So if you our results here, you see sort of 4 blocks of information in these bar charts. On the left, we're talking about income elasticity. How does oil demand respond to changes in GDP? On the right, it's price elasticity. We have OECD and non-OECD results, and we divided the time periods into 2 decades, 77 through 96, and then the next 2 decades, 97 through 2016. So again, when we say elasticity, what we mean is the percent change in oil demand from a percent change in GDP or oil price. So the way to understand these charts, if we start over on the left for the OECD, the blue bar, 77 through 96, we can see that in this first time period, a 1% change in GDP corresponded to a 0.5% change in oil demand. And then in the next period, 97 through 2016, the orange bar, that impact was smaller. It was about 0.46%. So a 1% growth in GDP or decline in GDP corresponds to 0.46%, about 0.5% in the same direction. And then for non-OECD, you can see that in the older time period, the 1% change in GDP was associated with a 0.7% change in oil demand, and that changed dramatically in the second period. And now the non-OECD economies have essentially the same response to income, the oil demand has the same response to income as the non-OECD countries. And you could see that too in the chart that we showed previously, where you saw the sharp decline in the gray line over the second time period. So that's income elasticity. And now we're looking at price elasticity on the right-hand side. Now, the first thing you notice, of course, is these numbers are negative, and that's because prices and demand usually move in the opposite direction. If prices go up, people don't want as much, demand goes down, and vice versa. When prices go down, people might want to buy more. So they have negative signs. And we can also see that in the 77-96 period, demand was more price elastic. People, consumers, responded more to prices than they now do. The price elasticity now in OECD countries is about -0.3. That means for every 1% increase in an oil price, demand goes down 0.3%, a third of a percent. In the non-OECD, when you look at the 1997 to 2016 period, the impact is very small, and so small that it's not statistically significant. So during this period, we didn't see strong responses to changes in oil price. So again, the takeaway is that income and price elasticities are both smaller now in absolute value than they were in the first 20-year period. They matter less to oil demand than they did in the past. And what this means as we start to think about what we might see for oil demand going forward, a lower income elasticity of oil demand implies flatter growth of oil demand, even when economies recover from a recession. So now let's turn to a look forward. Okay, So now we get the idea that there's two trends that can reduce oil demand after a crisis. Demand can reset at a lower level, a stair step down, and it may also grow at a slower rate because income elasticities of demand are smaller. So we have a sort of a stylized graphic here showing the downward ratchet and the lower intensity. So the orange line there is actual global consumption of oil. And if you go back to 1976 to 84, you can see that demand declined, the orange line declined. It never came back to the previous level. And not only that, the slope of demand, the change over time, that blue dotted line is somewhat flatter going from 84 out into the future than it was in 76. And then if we look, for example, at the period right after the global financial crisis in 2008, 2009, demand recovered, but it started to grow at a somewhat slower rate than it did in the past. And now here we are in 2020 with a decline in demand that's quite dramatic. And the question going forward is, to what level do we recover? How much can we get back up the stair step in the near term? And then sort of the slope of this red line, is it going to be the same pace of growth that we had in the past? Is it going to be kind of parallel to that other blue line, or is it going to be flatter? Are we going to have a smaller income elasticity of demand? And it looks very likely that that will happen, given changes to, for example, commuting and many other issues that are going on with air travel, et cetera, going forward. So what does this mean? It means that peak demand, people talk about peak oil demand, projecting out maybe in the 2040s or 2050s, but peak demand may be closer than it was projected before the crisis. And that has implications for oil company strategy, perhaps more rapid mergers and acquisitions going on, more consolidation in the industry, more decisions about investing in non-oil forms of energy, things that companies are thinking about now, but they had really had to accelerate these and put them on the front burner. They don't have as much time as they did in the past to deal with these issues. So I think it was Mark Twain who might have said that history doesn't repeat itself, but it rhymes. So I think that means this time it's different, but maybe it's the same too. So when we get back into growth, if you look back, in the 70s and 80s, global oil demand declined because we had high oil prices and a recession. But high oil prices incentivize oil production. So those high prices that you see there eventually came down. There was, as I mentioned, a lot more non-OPEC production coming online. And the oil market rebalanced as the economy recovered, demand recovered, even though oil intensity didn't. And it was an opportunity for new sources of oil. But this time it's different because demand is down strictly on economic activity, not on high oil prices. Oil prices are low. And they don't seem to be able to do much to help the recovery of oil demand. It really all depends on the economy. So in the near term, getting the market back into balance depends on producers cutting back. And it's a lot harder to cut back than it is to take advantage of a growth opportunity. So that's the difference. But the situation is also somewhat the same, because once the oil intensity of economic activity declines, don't expect it to come back. That's not been the historical experience. And then we just want to say a few words about implications for policy around climate change and economic development, geopolitics. First, a reset of demand can support efforts to, quote, flatten the climate curve. That's the Economist cover story this week. They use the phrase flattening the climate curve. Carbon taxes might be implemented. They not only discourage the use of fossil fuels, but can be a source of revenue as well. And governments will need revenue to help pay the bill for all the economic help that they've been putting into place. Lower prices give you some headroom to reduce fuel subsidies in countries that have fuel subsidies. And then various bailouts could have a green tinge. government investment in various kinds of renewables or carbon capture, whatever it might be. And then on the economic development side, some oil-dependent economies already have long-term plans to diversify. If they have the wherewithal, they may fast-forward plans like that. Saudi Arabia's NTP is such a diversifying plan. But then sort of on the darker side, the ongoing struggles for revenue in oil-dependent economies could lead to more regional unrest with incentives to damage one another's oil-producing capacity. So there are many other issues, as Elise mentioned, having to do with geopolitics and development. But I think I'll leave it here, and thanks for listening to the presentation, and then now I guess we'll take questions.
Thank you so much, Marie. That was an excellent presentation. Well, as moderator, I'll start off with the first question. And I'll just begin with recently, the Secretary of Energy, Dan Brulette, recently said that the US will cut production by about 2 million barrels a day this year. If oil prices remain where they currently are and the June cuts increase, do you anticipate curtailed oil volumes returning to normal in 2020, or will it be later?
Okay, well, there's a lot of pieces to that. So let's kind of go back and think about it. So we have cuts in production in some parts of the world that are, these folks could produce oil at $20 or $30, but they're choosing not to, right? So the OPEC countries. In the United States, it's somewhat different. A lot of the cuts in production are because it's barely economic to produce oil in some places at, say, $28, $30 a barrel. That's what we call operational costs, right? The lifting costs of oil, the out-of-pocket expenses. Those expenses in places that are very prolific, such as the Bakken and North Dakota, $25 or $30 covers some of the cost of production, but not all of it. So some of that production is shut in because they can't break even. If oil prices stay at, say, $30, it would be hard to see a lot of production coming back. And it's not just because of the economics of the operating costs of oil fields, it's because a lot of these producers are in debt. So taking a step back from the crisis, even before the coronavirus hit in 2019 or so, the capital markets started to kind of turn off the taps for a lot of the mid-sized oil companies. They had cut I would say both debt and equity spending from about $60 billion a year in 2017 to about $20 billion in 2018 or 19. So it looked like we had robust growth in places like the Bakken Shale or even the Permian at $50 or $60 oil. But a lot of that was debt financed. So, and what you have in the energy business is, if you want debt, you have to show that you're adding reserves. But if you can't drill enough to add reserves, and if you only have enough money to cover your production costs, but not enough money to drill more reserves, then you can't add reserves. And if you can't add reserves, you can't borrow more money. And if you can't borrow more money, you can't grow. So some of that 2 million barrels a day might come back, but there are longer term impacts. A lot of companies this year still have hedges in place. So a lot of folks, they know oil prices are volatile. They put hedges in place. Maybe they're hedged at $50. So while they're producing oil, they can earn the value of their hedge. The hedges are going to roll off next year. So even though we're seeing production $20 or $30, these guys might be earning 50, but they won't be next year. So I actually, and there's a few other driving forces there as well. I think it would be actually quite a struggle to see it all come back in the near term.
Yeah. Well, here's a question from some of our participants. They say many manufacturers are committing to electric vehicles. Just yesterday, France announced the goal to produce 1 million electric vehicles by 2020 or 2025. Sorry. As well, airlines are also beginning to add non-fossil sources to jet fuel. Won't these trends put us on a path to permanently lower oil consumption?
I would say eventually that I would say it will put us on a path to lower oil intensity of travel, let's say, and possibly GDP. You, I don't know that you could say it's permanently lower oil consumption. Oh, sorry about that.
No worries.
Okay. I muted both of my cell phones and I forgot to mute the landline. I apologize. Yeah, so going back to that. So yeah, I would say, I think we could agree permanently lower oil intensity, but the actual and the impact in demand would mute demand growth. But I think to say it's permanently lower demand, there's other factors in play, the speed of economic growth, for example.
Yeah. And then another question from our participants, why were oil prices so high during the 2011 through 2014 period? Was the shale revolution was underway? Was the market simply not recognizing its impact?
So that's actually a good question. So a lot of that was driven by very strong economic growth. And as oil prices were going up during that period, at first the oil companies kind of didn't believe it. So they really delayed investing and responding. So as we started to see $80, $90, $100 oil, they're like, this is kind of too good to be true. And we're not going to chase this price. We have a price deck. We have a planning price deck. It's 40. Yeah. So they're not. The larger companies don't invest based on spot prices. They invest based on the price that they think they're going to get 20 or 30 years out. Some of these projects, like the deep water offshore projects, the projects being done by the large companies, they take 10 years to explore, develop, put it together. They have very, very long timescales. So they're not looking at near-term oil prices and saying, great, we're going to drill. The Canadian oil sands are another example. So part of the reason prices got so high during that period is the supply response was slower. They had already kind of gotten burned in the 70s and 80s. So the supply response was a lot more careful and slow and measured. But eventually it caught up because they called it the long upcycle. That long upcycle went on for many years. The other piece of it is, yes, the shale revolution in the United States started on the gas side, on the Barnett Shale in Texas. And then, so that started taking hold. Gas prices in the US were very high around 2008. But by 2011, 12, 13 started to decline. And then the oil industry looked at that and said, well, if you can do it for gas, let's try it for oil. So starting 2010, 2012, that period is where you started to see the Permian Basin in Texas take off and the Bakken Shale in North Dakota. And that eventually reduced prices pretty dramatically. But there was sort of a delayed reaction. And what's quite interesting is that the very large oil companies, the super majors, were generally going after very large offshore projects, international projects. It was in the United States, the mid-sized companies and independents who really developed the technology and got things moving in the shale. So it's interesting to see different pieces of the industry and how they respond to prices and technology availability.
Right. Well, here seems to be a question from another econometric expert. They're asking, what were the error bars on your calculations of income and price elasticities?
They were, I can send you I have to look at my notes, but both of them were significant at 95%, T-stats. We didn't actually do error bars, but I can follow that up and send it.
No worries. I would also like to note to everyone that Marie's paper is on our website and that can be found and you can download it. And this recording will also be on our website as well as the PowerPoint presentation. So you can find all of that information at www.usea.org. Here is one more question. We have, how much of an impact do you expect carbon capture in the incentive, the 45Q tax credit, to have on future production in the oil and the carbon market?
That's hard to say. I haven't looked at it in a lot of detail, so I have to pass on that one.
No worries, no worries. Let's go to another one. How would you say the respective new roles of demand and supply factors in the wake of COVID-19 will affect the industry economic outlook?
Well, as I mentioned before, the oil industry is totally dependent on supply restraint for prices to recover. Low oil prices stimulating demand, it really isn't going to do it. Demand is low for other reasons. And in a way, they're not even economic, right? The reasons demand is low is because the world is trying to control a virus pandemic. So in the near term, and probably for a longer period of time, to have a market that oil producers would consider to be in balance, and that can be a normative term, but let's say that's $50. It's really going to depend on the supply cutbacks and the restraint from the low-cost producers, which tend to be the OPEC countries or OPEC plus. So rather than these countries, obviously they want to support prices. The other producers are much more dependent on them, and probably from the investment side, because obviously the money has to come from somewhere to develop oil. Investors are probably going to be much more wary. They're not going to take $50 oil for granted. So it's going to be trickier for people to make investment decisions, I think. And no one's going to look for the demand side to all of a sudden come roaring ahead in the long term.
Yeah. Do you by chance see that mergers and acquisitions will be playing a more significant role in the oil and gas sector and drive kind of market share for major producers?
It's possible. There's certainly bankruptcies. And to the extent that some of these companies going into bankruptcy still have attractive acreage, they might be acquired by another company. There have been some stories too about, rather than bankruptcies, some companies just liquidating because it's all happening so fast, it's hard to find a buyer, and then some of the debt holders, which is who you have to satisfy in a bankruptcy proceeding, don't want equity in the companies. So it may not be a wave of M&A more as just assets getting sorted out rather than companies.
Great. And then we have a couple more questions from our audience, and one of them is asking, many more people are starting to work from home with the pandemic, and some of them will continue working from home after the pandemic. So this will increase or decrease the amount of transportation, as you've said, and that was only a portion of, I think, 20%, correct, on your pie chart. And there might be an increase in electric vehicle production and that sort of thing. So with all these changes, how do you think that will shape the oil recovery chart?
I actually think what it will do is, we show the chart with the red lines going forward. Yep. I think we'll be on a flatter red line path. I don't think when the economy recovers and things get back to quote normal, we're going to be at that 0.46 elasticity of oil demand relative to GDP. That's going to end up being a lower number.
Yeah. Well, I think we are done for today. I would like to thank Marie so much for taking the time and sharing her research. And I would like to thank our audience for joining us for this webinar on the future of oil demand. If you are interested in learning more, please go to our website and you will find everything, as I said before, on the registration page, this recording, the paper, and also the PowerPoint presentation. I thank you again, and I hope you have a wonderful rest of the week. And thank you, Marie.
All right, thank you. And thanks everybody for listening in.